Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. We've been talking about the myths of traditional myths, we'll call them, for traditional investing strategies. And this goes with, again, stock picking, track record investing, picking money managers based on what they've done in the past, and market timing. This is one of the big ones. In fact, I think one of the most common questions I hear when someone comes in for this first time is, where do you think the market's going to go? And for that matter, even doing, a lot of times when we're doing reviews and that can come up. And we remind, of course, this is where understanding how the markets work, when it comes to investing, all right, we're not trying to predict what's going to happen. We know that there are going to be ups and downs. What we're doing is we're looking at, well, what's needed to accomplish your financial goals, and how do we put a financial plan together to accomplish that? And then the investment plan that's going to be the underpinning of that, of course, it's going to be the one that determines what kind of return you're going to get, what type of income maybe from your portfolio, what type of growth is necessary, all of these things. So that, again, it's determining what is the needed rate of return. A lot of times clients come in and I'll ask them, how much you want to make on your money? And they'll say, well, I'd like to make as much as I could. Well, if you lost it all next year, how would that be? Well, no, I don't want to do that. So we're starting to narrow it down. Well, what would you be comfortable with? And this is one of the things with traditional investing as well. When you see an advisor, they want to determine, well, what's your risk tolerance? If you lost 10% of your money, would you bail out of the market or would you stay invested? What about 20% or 30%? And they're trying to figure out how aggressive they should be in your portfolio. I operate a little differently. What I want to do is I want to find out, well, what's the needed rate of return and how can we minimize risk so you have peace of mind and comfort there and are able to, in fact, accomplish your financial goals that way. All right. Now, if you'd like to see how this would work for you specifically, get an investment analysis done of your portfolio, then here's what we're going to do. For the first 10 callers to my office, 615-376-5325. Tess is standing by. She'll get your information. She'll send you out a checklist of things to bring to your appointment with me. And what we're going to do is we're going to do a comprehensive plan. As I said, this is looking at what your income, your expenses, your assets, any liabilities. We're going to look at all of that, what you have now and what you're going to have in retirement. And if you're already retired, of course, that makes it even easier. We're just looking at one thing. And then we're going to say, okay, based on what you're currently doing, we'll look at your current investments and how I've had a lot of folks coming in lately that have got money that's just in cash, just sitting in bank accounts and stuff because they've been nervous about the market. And we show them how they can safely get returns on their money and still have that peace of mind they're looking for. And here's the other: why do you invest in the market or have an investment strategy beyond just keeping everything in savings checking or savings bonds or fixed annuities, that kind of thing? Well, we need to get enough of a return to stay ahead of inflation and taxes. Otherwise, our purchasing power is going to go down and we're not going to be able to maintain our standard of living. So again, first 10 callers to my office, 615-376-5325. Tess is standing by. She'll get your information, send you out a checklist of things to bring to your appointment with me, and we will do up a plan for you at no charge. In addition, when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. And guess what? This is in the book, I cover much of the same things that we're going to be doing for you in the planning. We get into, in the first 2 chapters, much of setting up that foundational plan. And then we talk about IRA mastery. This is about, you build up all that money in those tax deferred into our retirement accounts, but when we pull it out, it's taxed at the highest ordinary income tax rates. So how can we minimize taxes when we're pulling money out of the portfolio? So, out of your retirement plans when you retire. How to do that. Talk about Roth and Roth conversions. We get into safe money aspects. We talk about annuities, the good, bad, and the ugly of annuities, the difference between fixed and variable and fixed index annuities. We talk about how the smart money invests. Much of what I'm going into at the beginning of today, how the smart money invests, is talking about this 50 years of Nobel Prize winning academic research and how to use it to your advantage to get the returns you need, all right, to accomplish your financial goals, to be able to attain and maintain your standard of living and quality of life no matter how long you live, right? And to do so as safely as possible, to minimize your risk and volatility when doing so. So that's on chapter 5, and then also talk about long-term care in the book, and of course estate planning. So all of that's covered. Now, when it comes to investing, I've been talking about indexing. So let me go into that a little bit more. So what is indexing? An S&P 500 index fund is an example. This is the 500 largest companies in the United States. These stocks are weighted, meaning there's percentages of them. They're not all equally in the S&P 500 index. So we have some representing different weights, if you will, or different amounts of money in each of these individual stocks. So this S&P 500 index fund, then, we have these 500 companies. Guess what? They don't change. Okay, unless the S&P 500 index change. In other words, unless the companies represented in there no longer meet the criteria, then they would be dropped. An example, an extreme example, in fact, might be a company like an Enron, for instance, that is in the S&P 500 index and then all of a sudden gets dumped out because of the it becomes valued less. So if the S&P, if a large cap is no longer fits that criteria, it's dropped out. This kind of thing only happens maybe 2 or 3 times that we would see that over a period of years. So doesn't change much. It's a buy and hold type strategy, and that's what indexing is about, is we're looking to buy. In this situation, these are large caps. Now we might look at a Russell 2000. This is the largest of the largest 2,000 of small companies on the marketplace. So when we're looking at a Russell 2000, now we've got another type of index. We've got a small cap. These are small companies, and we might blend that together with a large cap, the S&P 500. Now that's just one basic of what indexing is. Indexing then is holding a basket of stocks that doesn't change versus active management, where we see a mutual fund where we have a lot of turnover, okay? This turnover ratio, a lot of trading that's going on, and we're going to talk about this hidden cost, in fact, and how it impacts your returns. All right, and this is the difference between an index strategy, say an S&P 500 index fund, mutual fund, which just holds those 500, give or take, stocks, and doesn't, as I said, changes minimally over the years, versus an actively managed large cap mutual fund where we might have 50, 60, maybe 100, give or take, companies represented in there with a turnover ratio that could be 40, 50, 100% even, creating a tremendous amount of hidden costs for you. And we're going to talk about those hidden costs and how those work in our next myth, okay? So we've talked about, again, stock selection, stock picking, all right, track record investing, market timing. Now we're going to get into the costs of investing. So let's take a look at the next slide. On costs of investing, this is fees that are incurred by investors to buy and sell and own stocks or mutual funds. Now, this cost of investing can look at, there are a lot of different ways this comes in. One is you may have advisor fees. 2 is you may have, in addition to that, there could be sales loads on mutual funds, and this can range from 1% to almost 6%. These can be quite high, in fact. In addition, you're going to have expense ratios. This is what the fees that the funds themselves charge for any number. This has to do with marketing. This has to do with their admin costs, a number of things there. And here again, you can have costs that are quite high. And then we have even other, now these fees you see, you'll either see them deducted from your statement, or as far as the expense ratio, you may not see that one actually deducted, but if you looked at your prospectus, it is disclosed in there what those fees are. When I do an investment analysis, when I have new clients that come in and we're looking at what their current portfolio looks like, the mutual funds that they hold, I will show them Morningstar reports and show them what those expense ratios are on their current funds. And we typically see fund fees that range from anywhere from 0.5% to, I've seen as high as 2% or more, just on the expense ratio, okay? Now you still have your advisor fees, what your advisor is charging, or sales loads if you're dealing with actively managed funds in that regard. And of course, you can get into even heavier costs if you have sub-accounts, which are like mutual funds, say in variable annuities. All right, this can add even more. It can actually even double, in fact, your expenses. So understanding how these costs work. And money managers, when you're investing in a mutual fund, they're thinking, you know, the concept basically that they're pushing is that they're going to be able to overcome these costs in their ability, to pick stocks, to time the market, right? We know that doesn't work. So let's take a look, though, at costs of investing. Now, here's a hidden cost. This has to do with trading. So I'm talking about an actively managed large cap fund, okay, large company fund. What are we seeing again is we see a small amount of stocks relative to that market. You may, in other words, the S&P is 500, and yet this large cap may only have, and these are the large cap fund. So, but the large cap actively managed mutual fund, as I say, may only have 10% or 20% of that amount, typically, maybe even 30%, but that's still quite small. All right, and with a high turnover ratio, and the higher that turnover ratio, meaning they're buying and selling stocks all the time. And what is that doing? Well, let's take a look. What is this called? This bid-ask spread, and of course the other mutual fund expenses that we get into. And a lot of people come in, they're unaware of this. They don't know what these costs are. So I want you to understand how this works. So let's take a look at the bid-ask spread as an example. It's directly connected to buying and selling of stocks. So if I, for instance, and this goes to the broker-dealer. So if you're looking to sell, all right, well, in fact, here's what we're going to do. We're going to have to take a quick break. So I'm going to jump into this when we come back, and I'll go into the bid-ask spread and how what you're selling for and what the buyer is buying, that there's a difference in between. This goes into the expense part, and this comes back and takes from your returns and actively managed mutual funds. All right, we'll get into that more. Join us here. We'll be right back on the Retirement Report.